Click the bell icon to get latest videos from Ekeeda.
Hello friends, today we'll discuss one of the technique of cost accounting, that is marginal costing, which is very much important from examination point of view as well as it is very practical in business life. Let us understand it. The concept of marginal costing is based on the basic feature of cost. Cost means all types of expenses. Like in business we have expense of material costing, that is input for production of, say example, any shirt we require a cloth, that is called as a material. So material is an expense. Similarly we require human efforts, that is labor, that for which we pay wages. That payment of wages is also an example of cost. Apart from that, there will be some expenses which are directly connected to production. For example, royalty paid on production. If our production is based on some technique which we have taken from the other person, then we are required to pay some amount as royalty to that person, which is called as royalty on production, which is a direct expense related to production, which is also a cost. Or for example, any special machinery purchased or special machinery got on hire for production, that hire charges which we pay, that is also called as a direct expense, which is example of a cost. Apart from this, there will be factory salaries, office salaries, sales salaries. These are the examples of cost. Overheads, electricity bill of factory, electricity bill of office, depreciation on machinery, depreciation on delivery van, depreciation on computer, and so on. So cost is associated with the product, and when we are fixing the price, we are required to take into account all types of cost which are related to the product, and we are required to consider the amount of profit which we are going to charge on cost so that we can arrive at selling price. Now this cost is basically of two types. First, we'll try to understand the concept of fixed cost. The word fix here denotes fixed for a particular period. These are periodical cost. For example, monthly we are paying rent. So monthly rent which is paid, it is considered as periodical cost, it is called as fixed cost. Now when we are paying the amount of rent, it is not associated with the output. If we produce 100 shirts, we are required to pay same rent if we produce 200 shirts. If there is no production, zero production, still we are required to pay rent to the landlord. That is called as what? Fixed cost. Salary payable to employees. Now salary every month we are required to pay, wages we are required to pay every month. Now these salaries and wages which are of fixed nature, if we are paying monthly, that will be considered as an example of fixed cost. If you produce or you don't produce, you are required to pay salaries to the employees. That is example of what? Fixed cost. So fixed cost we can't avoid. Therefore it is called as unavoidable cost. That means if you are continuing with the production, if you are running the business, if you are keep your shop open, you are required to, you are bound to pay fixed cost. You cannot avoid it. Another type of cost is variable cost. Now what is variable cost? Variable cost means the cost which varies with output. For example, material cost. Material is an input. The cost expense of material depends on your output. If you produce more, you will have to spend more on material, so your material cost will increase. If you don't produce at zero output, material cost will be also zero. So as output rises, total material cost will rise. As output falls, material cost will fall. So that means material is a variable overheads or variable cost. Direct labor, if we pay piece rate to the employees, that means depending upon the production, if we are paying the wages, if there will be more production, we'll have to pay accordingly more wages. If there is less production, we are required to pay less wages. If there is zero production, there will be zero wages. That means direct labor is variable cost. So in any business, we come across two types of cost. One is called as fixed cost and other is called as what? Variable cost. Fixed cost, fixed cost remains fixed at all levels of output. Variable cost varies as per output, that means it changes as per production. So manufacturer, he is more concerned with variable cost because it can be avoided. What it means these are not compulsory. If you don't produce at all, you are not required to pay direct material cost, direct labor cost, because if there is no production, these costs will be zero. So if in your business, if you are facing a situation where you are not able to cover your variable cost, you should stop production, because fixed cost you cannot avoid. Even though fixed cost you are not able to pay, but you are recovering variable cost in the short run. In the long run, there is hope of recovery of variable as well as fixed cost. But during short run, if you can't recover your variable cost, you are required to stop your production to avoid future losses. If you can't cover your cost, that means manufacturer will be facing the losses. Marginal costing concept is based on this, and accordingly we are having some of the valuable equations in marginal cost which helps manufacturer to take important decisions of manufacturing. So if we can summarize the cost, total cost, it is of two types: fixed cost and variable cost. So if I want to know my profit, my equation will be, this is the equation of profit: sales minus variable cost minus fixed cost, we are arriving at the figure of profit. Sales minus total cost is profit. Total cost is of two types: fixed cost and variable cost. So sales minus variable cost minus fixed cost, we are arriving at the figure of profit. We will try to manipulate this formula. We are keeping on one side sales minus variable cost. So fixed cost will go to other side. If we shift fixed cost to other side, it will become fixed cost plus profit. So in nutshell, sales minus variable cost is equal to fixed cost plus profit. In case of marginal costing, we use a term called as contribution. How we arrive at contribution? Sales minus variable cost is equal to contribution. That means selling price is helping us to recover some amount of variable cost. So sales minus variable cost is called as what? Contribution. The amount of contribution helps businessmen to take various decisions relating to manufacturing. Here we have seen sales minus variable cost is equal to fixed cost plus profit. That means contribution is equal to fixed cost plus profit. So we can manipulate this formula to arrive at fixed cost or profit if they are required to be found as missing figure. For example, fixed cost of a business is equal to contribution minus profit, or profit of business is equal to contribution minus fixed cost. So to arrive at estimated profit, we can use certain formulas like this. That is the benefit of marginal costing we have. After contribution, important concept in marginal costing is ratio called as profit volume ratio. What is profit volume ratio? Contribution upon sales multiplied by 100. It shows amount of ratio of contribution to sales. For example, contribution is 70,000, sales is 1 lakh, multiplied by 100 we got 70%. What it says, that it says that if sale is rupees 100, our contribution is 70 rupees. If it is 70%, then we can know variable cost. If contribution is 70% of sales, that means 100 minus 70, variable cost is 30% of sales. That is the advantage of profit volume ratio. Here the word profit means not a net profit of business. Here profit means contribution. So we are required to be careful while using this formula. We should not assume profit here as net profit. Profit means we have to consider as contribution. That is sales minus variable cost is equal to contribution upon sales multiplied by 100. So this is important formula called as profit volume ratio. Next concept associated with marginal costing is break-even point. Now what is break-even point? Break-even point is a point where manufacturer will not have profit, he will not have loss. It is a situation of no profit, no loss. Now what is the benefit of knowing break-even point? If you can know break-even point, you can plan your sales to avoid losses. If you are at break-even point line, that means there is no profit, no loss, so you are ensuring that your business will not have any loss. If your sales exceeds break-even point, you start making profit. So you take care that your sales should not fall below break-even point, because there you will be incurring a losses. So that is a very useful concept of marginal costing called as break-even point sales. How to find out break-even point? Break-even point in rupees. AC बंद कर थोड़ा. Formula for break-even point in rupees is fixed cost divided by profit volume ratio. For example, fixed cost is 1 lakh and profit volume ratio is 50%, then break-even point sales will be rupees 2 lakhs. That means if manufacturer is successful to make sale of rupees 2 lakhs, he will be recovering his cost. There will not be any profit, but there will not be any loss at that particular level of sales. Break-even point we can also obtain in terms of units. The formula is fixed cost divided by contribution per unit. For example, fixed cost is 1 lakh and contribution per unit is 20. Then break even point in units is 5000 units. That means manufacturer can know how many units of product he will require to sell so that he can recover his entire cost. There will be no profit, no loss. That is what the use of break even point in units formula. If we know break even point in units, we can also calculate break even point in rupees. Formula is break even point in rupees is equal to break even point in units multiplied by given sale price. This is the concept of break even point. Margin of safety. This is the margin line or this is the border line which helps manufacturer to plan his sales properly to avoid the amount of loss. Formula of margin of safety is actual sales minus break even point sales. If your actual sales are 5 lakhs and your break even point sales, say suppose 2 lakhs, then margin of safety is rupees 3 lakhs. It means manufacturer has to focus on sales in such a way that sales should not fall below rupees 3 lakhs. That means if actual sales are 5 lakhs, they should not fall below 3 lakhs, because if sales fall by 3 lakhs, it may go down below the break even point line and it will start making the loss. So it shows a signal where the seller can plan his sales to avoid the amount of loss. This is called as the concept of margin of safety. Any manufacturer is interested to know how he can arrive at particular amount of profit. For example, how much sales he will require to make. If you want to make profit of 5 lakhs or profit of 10 lakhs, marginal costing helps manufacturer to plan his profit with the help of equation. Required sales is equal to fixed cost plus desired profit divided by profit volume ratio. For example, if fixed cost of business is rupees 2 lakhs, manufacturer wants profit of 2 lakhs and PVR is 50%. So in this case, manufacturer will require to make sale of rupees 8 lakhs to ensure that he will get profit of rupees 2 lakhs. We can verify this equation. One of the formula of contribution is equal to sales multiplied by PVR. Here we got sales 8 lakhs multiplied by PVR 50%. So contribution is 4 lakhs. Profit is equal to contribution minus fixed cost. Here contribution we got 4 lakhs minus fixed cost 2 lakhs. So there will be profit of rupees 2 lakhs. That is desired profit in this question. This is how we can find out desired amount of profit and required sales for that purpose. Like cost sheet, in case of marginal costing, we can prepare marginal cost statement like this. We have to start with the sales. From sales, we are required to deduct variable cost, direct materials, direct labor, direct expenses, variable overheads, variable factory overheads, variable office overheads, variable sales overheads. After grouping all variable expenses, we are required to take total of this and we have to deduct from the figure of sales. Sales minus variable cost, we arrive at concept of contribution. Then we are required to deduct fixed cost. Fixed factory overheads, office overheads, selling overheads, any other fixed cost that will be deducting here. Finally, we arrive at figure of profit. This is the marginal cost statement which is prepared similar to that of cost sheet. Let us go through the important terminologies in marginal costing. Sales minus variable cost, contribution, S minus V is equal to C. Contribution minus fixed cost is equal to profit. Sales minus variable cost is equal to fixed cost plus profit. Profit volume ratio, PV ratio, contribution upon sales multiplied by 100. If you want to find out contribution, other formula is sales multiplied by PV ratio. Sales is equal to contribution divided by PVR. Break even point in units, fixed cost divided by contribution per unit. Break even point in rupees, fixed cost divided by PV ratio or fixed cost divided by contribution multiplied by sales. Break even point in rupees, other formula is fixed cost divided by PV ratio. To get required sales, fixed cost plus desired profit divided by PV ratio. Required sales in rupees, actual sales we can find out fixed cost plus profit divided by PV ratio. Margin of safety, actual sales minus break even point sales. Margin of safety in units, actual sales in units minus break even point units. Profit is equal to margin of safety multiplied by PV ratio. To know contribution, sales minus variable cost or fixed cost plus profit or sales multiplied by PV ratio, break even sales in units multiplied by contribution per unit plus profit, or break even sales in value multiplied by PVR plus profit, or fixed cost margin of safety in units multiplied by contribution per unit, or fixed cost plus margin of safety in value multiplied by PVR. Profit divided by margin of safety in percentage, we can get contribution. Fixed cost divided by break even sales in percentage, we can arrive at contribution. Profit volume ratio, PVR, sales minus variable cost divided by sales multiplied by 100. Contribution divided by sales multiplied by 100. Fixed cost plus profit divided by sales multiplied by 100, or fixed cost divided by break even sales in value multiplied by 100, or fixed cost divided by break even sales in units multiplied by 100 divided by selling price per unit. Break even sales in units, fixed cost divided by contribution per unit. Break even sales divided by selling price, fixed cost divided by selling price per unit minus variable cost per unit, or actual sales in units minus margin of safety in units. Break even sales in value, fixed cost divided by PVR, or actual sales in value minus margin of safety in value, or fixed cost divided by contribution per unit multiplied by selling price per unit, or break even sales in units multiplied by selling price per unit, or fixed cost divided by 1 minus variable cost divided by sales. Fixed cost divided by percentage of contribution to sales. Break even sales in percentage of sales, fixed cost divided by contribution multiplied by 100, or break even sales divided by actual sales multiplied by 100, or 100 minus margin of safety in percentage. Margin of safety in units, profit divided by contribution per unit, actual sales in unit minus break even sales in units. Margin of safety in value, profit divided by PV ratio, actual sales in value minus break even sales in value, or profit divided by contribution per unit multiplied by selling price per unit, or margin of safety in units multiplied by selling price per unit. Profit, sales minus total cost, or sales minus variable cost minus fixed cost, or contribution minus fixed cost, or margin of safety in value multiplied by PVR, or margin of safety percentage of sales multiplied by total contribution, or margin of safety in percentage multiplied by actual sales multiplied by PVR. Sales total cost plus profit, or variable cost plus fixed cost plus profit, or variable cost plus contribution, or contribution divided by PV ratio multiplied by 100, or break even sales plus margin of safety sales. Required sales for in units fixed cost plus desired profit divided by selling price minus variable cost per unit, of fixed cost plus desired profit divided by contribution per unit. Sales required value, fixed cost plus desired profit divided by sales minus variable cost multiplied by sales. Fixed cost plus desired profit divided by total contribution multiplied by sales. Fixed cost plus desired profit divided by PV ratio. Additional sales required to maintain present amount of profit. Formula is additional sales required in units, proposed expenditure divided by contribution per unit. Additional sales required in value, proposed expenditure divided by PV ratio. So we have discussed all elementary concepts of marginal costing. With the help of these formulas, we can take various important decisions of business, like whether to produce or purchase product from the market, or decisions like how to use install capacity, or decisions like discontinuing of the particular line of product, etc. Thanks for watching this video. Stay in tune with Ekeeda and subscribe to our channel Ekeeda. Thank you.